Hello teacher, my name is Manvi Kaur Sidhu. My student ID APS 3500. My institute number Holmes Institute. My topic is the accounting for income tax. Tax accounting is used for the meeting for the obligation of the tax authorities. It aims of the tracking assets of fund belonging to the individual organization. Governance by the significant set of to law the Australia government annual report of the welfares limited to used reference the different parts accounting profit taxable profit temporary differences deferred tax assets and deferred tax liabilities and account profit income that has been the obtained of the organization during to the significant financial year can be termed as profit account profit and the taxable profit it is the significant profit in the even loss of figure which is the taxable under the income tax assets act of the term taxable and temporary difference is two type taxable type different and dutiable temporary difference it the books of the tax income don't match that can be referred to the temporary difference tax assets tables temporary difference leads to different tax as to decreasing that the tax income during to the further present deferred tax liability and deferred tax liability can be considered to tax liability which is during for part during current financial but has not yet like is the every year and then next okay the tax accounting is the criteria recognition criteria deferred tax assets DTA limited of the DTA limited to the reasonable current for their reason that historical financial data of the organization and temporary differences and deferred tax liabilities assets exceed to the tax based and the taxable temporary difference okay regional of the recording DTL and DTL further profit consider to depass the expensive liability incomes impairments bad debts and etc debts in the present of the tax liabilities better finance inside of the companies helps of the investors and buyers and the tax expensive and income tax payable the formula is the income tax payable equal income tax expensive plus DTA and minus DTL. Income DTA deferred tax assets and deferred tax liabilities. Income tax expensive is the three parts. First is the cash based method and financial second is financial accounting highlight of the income statement income tax payable approval method tax accounting and the balance sheet is in the shows okay next slide is the tax rate uh, and the accounting income minus difference like the tax rate and accounting income in which difference first tax rate minus tax law and in and accounting income is the JAAP are applicable like is the JAAP approvals and second is the book and the tax profit of the difference to the other and treatment of the items different and the allowance and the is the two rules first is the allowance and disallowance tax difference of the types the two types first temporary tax difference and difference between financial and tax account of the different annuals. Deferred tax assets and the deferred tax liability can be generated, and expensive can be reserved, and tax rate is are not effective in the temporary, because it's a temporary, like is the sometime, uh, not a long time. And permanent tax difference is the difference between financial and the tax account can't be eliminated. It's not it's not a short term, it's long term, can't be generate of the deferred tax. And expensive can't be reserved, be not reserve, and expensive rate of. Okay, tax under income and cash flow statement. Income statement, reserve of the generate and expensive can be non-cash items. And approval method of based in the income statement, it shows the probability and depreciation in also our income statement including operate and non-operate activities. Cash statement shown the cash influence and outflow flow. And cash flow statement based on the cash system, it shows the liquidity and the status. In cash flow statement includes investors, operator and financial activities. Tax treatment financial. Tax treatment in the financial statement, count of the tax assets and liability of the welfares limited in the no. Duplicated temporary difference used tax losses and the assets of the exempt. And tax treatment in the financial statement, capital in the management of risk and other of the financial 39 million in the cash capital losses. By summing up both accounting and tax profit of the company, we can know that actually financial statement as well as the obligation is the overall tax is the based on the accounting and taxable profit. And last, reference is the is the very important. Hamilton are 2018 new avenue of investors, and valuation of the different tax of the liability, and other all reference in here. So thank you, teachers.